Welcome to Value Research Helpline. I'm Ruchira, and our experts here at Value Research are now all set to answer your queries on investing and personal finance. Joining us today is Dhirendra Kumar, CEO Value Research. Welcome, Dhirendra.
Thank you.
Today's first question comes in from Rajeshwari Kulkarni, who wishes to invest in mutual funds for her 6-year-old daughter's higher education and her retirement. Rajeshwari is currently 36 years old. As of now, she can invest 20,000 rupees per month. She is employed in private sector and has an emergency corpus of 5 lakh rupees, an FD of 10 lakh, a term insurance and a medical insurance.
Rajeshwari has, built a great foundation on which to build a long-term growth portfolio, and because the goal is, far away in future, so most of the money should be invested in equity. And one important thing to keep in mind, of course, she can go to Value Research online, look for our curated list of analyst choice in our on our website. But more importantly, when she gets closer to the goal, then she should start moving a part of the money gradually. You invest regularly, and you disinvest regularly as you get closer to your goal. So that is something which she should remember, which is in the distant future.
All right. Avadesh Pandit wants to know if it's safe to invest now in debt funds for a period of 3 years. He also wants to know the difference between FMP debt fund and corporate bond fund.
For 3-year period, you don't have a choice. Even if something else is attractive for a 3-year time period, one should always only invest in debt. Is the only option for you for this time frame. Equity is not an option. Maybe a conservative hybrid fund could be one option. But I would say that it's not about the state of the market, but for 3 years time frame, you should be investing only in a debt fund. FMP is pretty straightforward. It is almost like fixed deposit in the format of a mutual fund. So it opens on a day. In between, you can't take your money out, and there is a maturity date which is preset at the time of issue itself. The corporate bond fund, that money, and of course, the difference is most corporate debt funds are open-ended funds. You can invest anytime, take your money out anytime. And FMPs invest with a very great clarity that they will be buying bonds which will coincide. The majority of those bonds will coincide with the majority of the FMP. So you have greater predictability of the FMP returns from FMP. And the compromise is that you will lose you don't get the liquidity. In case of an open-end corporate debt fund, you can take your money out anytime.
All right. Ashish Beke is currently investing via SIP in an ELSS, multi-cap and small cap funds. For a balanced portfolio, he now wants to add large and mid-cap fund and short-term bond fund. Ashish wants to know if that's the right decision, or should he instead go with aggressive hybrid fund?
I would say that investing in an aggressive hybrid fund simplifies the whole thing, and there's absolutely no tax implication of the allocation changing. The difference between you doing the changing, making changes in your allocation as compared to a fund manager doing it is that there is no tax consequence of a fund manager doing it. Right? You entrust your money in a aggressive equity fund, and the fund manager is making all kind of changes all the time. But you are responsible for any. You will be liable to pay taxes only when you take your money out from the mutual fund. So that is, you are saved of all the headache of filing returns and all short-term gains or long-term gains and all that. Then resetting of allocation. But I would say that the way you have built your portfolio looks reasonably good. Resist your temptation to add any more fund. Maybe you will have some surprise in terms of the multi-cap funds. Some of the multi-cap funds will turn into a different kind, the new category which has been made possible or allowed by SEBI. So they will all be, they will all become flexi-cap fund, and so don't add more funds to your portfolio. You have way too many. Have that short-term bond fund only for your fixed income allocation. If you have decided on your asset allocation, I think having a short-term debt fund is a good way of achieving that allocation in the debt.
Okay, the next query has been sent in by Ali Asgar Khambati, who says, and I quote, "Watching the series Scam of 1992, I'm wearily reminded of the time of the stock market bubble, which seems apparent today as well, with mind-boggling valuations on stocks without any fundamental improvement. Do you still suggest for retail investors to invest right now? If so, why and how?"
1992 and 2020 are very different. In 1992, Harshad Mehta took bank's money and invested in the market. This was unusual. This was unprecedented. Indian markets were, they were, old generation. Everything was done on the trading floor that you're watching on in the story now. So the market complexion has changed. The number of investors, FIIs were not allowed to invest. One more important thing is that SEBI did not exist in 1992. In fact, SEBI came into being because the 1992 scam happened. So we have a stock market regulator as a result of the 1992 scam. We have diverse set of investors, domestic institutions. We did not have mutual funds, as you find in that series. That the only thing was being referred was UTI, and that was it. Today we have many mutual funds and they're channelizing money. UTI mutual fund today is number 5. We have bigger mutual funds in the business. So I don't see concentration of investors, and if a lot of investors pull out money in a hurry, in a brief period of time, markets can collapse. We witnessed it in 2008. The markets went down by about 45%. We saw it in the month of March, when the pandemic, and the result in the 5-7 days was the markets went down by 40% in 7 sessions. That was quite unreal, and this can happen if a lot of investors come and take their money out. But I don't see that the markets can go down and remain there for a long period of time, which we witnessed in 1992. When 1992 investors, when the money went back and the scam was unearthed, after that we achieved the 4,000 level on Sensex. Many years after that, in 2002, it took 10 years for the market to achieve the same level again. So this was a 10-year period. The recovery took 10 years, and that's so I would say that 1992, the complexion of the market was very skewed towards few people. It could be manipulated, and 1992 scam was complete manipulation. I think 2020 we are far more diverse. Investors are making informed decision. The number of investors of all kind is varied. So I don't see a racket of that kind. Yes, there are valuation concerns, and I say some part of the market. If you would have witnessed that, banking stocks have not generated any return in the last 2, 3 years, 4 years. We find pockets of undervaluation. We find pockets of a set of industries where investors haven't made any money. In fact, they have lost money. And a small segment of the market where investors have made money. The market has gone up. Market shows resilience. And many of those companies, if you look at the complexion of the banking sector, 3 companies actually make all the money, and rest of the industry loses money. So we find that money is getting concentrated in fewer companies, and they are very high quality companies. There could be a case that market can, there could be a time correction. Market doesn't go up, and so your money is not growing, and time passes by. That is the worst case scenario which I witness. And to deal with this, I would say that stick to a plan. You should always reduce the possibility of catching a market high. That is what is there in the hands of an individual investor. Because if you get worried about the valuation, there will be 50 other concerns as well. And I'll mostly agree with them. But then you have to be in the market, because the biggest turnaround happens when you least expect it.
Akshay has written to us with a query on sectoral funds. He holds one banking fund of SBI Banking and Financial Services and one IT fund of Tata Digital India. He says his returns are currently skyrocketing, but is it really worth it? Because, worth continuing the SIP, as they may not hold their absolute value in the long term. His plan initially was an SIP for 5 years.
Good till it lasts, but I would say that you are taking a risk in terms of concentrating. The reason why I keep suggesting that invest in a mutual fund and do your SIP. The primary, what is in your hand is to diversify well. And if you have been lucky with these 2 sector funds, and I still hold the view that some of these funds will do well. Maybe they will do better over a 5-year period than a diversified fund. But the lack of diversification, and whenever we see the correction, maybe you go to Value Research Online, look at these 2 fund pages, look at the worst period in their life. You will get a sense of what could be the worst case scenario in the life, what has been the worst case scenario in the life of this fund. And will you be okay with that? If you will be fine with a 40% decline in a 3-month period, which has happened in the banking fund, then by all means stick to this. Otherwise, if you're sitting on massive gains, maybe take your money out, say thank you to these two funds, and invest in a diversified equity fund.
All right. Next question comes in from Amit Jyoti Lakhar, who wants to know, with the markets at a high, would now be a good time to invest in debt instruments instead of buying stock? Also, what about investing in gold under these circumstances?
Value research has a view on gold, that gold is not an asset class worth investing. And it's a store of value. And today it is possible to hold it in a financial form. And once in a while, when we see great turmoil all over, gold, there is a fancy for gold even in the financial market. But we don't see it as a productive asset class. When you invest in equity, you become a part owner of a company. And that is what a mutual fund does when you are investing in an equity fund, that the fund manager buys on your behalf and he becomes a part owner. And then somebody is willing to pay a premium if company grows. And that's it's a general bet on the economy and different companies. Likewise for debt, you lend your money to somebody and you are being assured that, okay, I'll pay you this much interest. As compared to gold, the thing just sits there. It just sits in your locker. It is not producing anything. Even a house has some value in terms of it's a productive asset. Either it is saving you, it is providing you the shelter, and you are saving money on the rental outflow, or you rent your house and get some money. So there will be some rental yield on that. Gold has none. So keep this in mind. So have some small allocation, and don't think in terms of this much percentage. Have some absolute value allocation as part of your emergency fund. Then comes whether you should be investing in equity or debt. Very difficult. I would say the reason why we invest in debt are two. One is that it helps you achieve an asset allocation, which every investor should have. You decide to invest a fourth of your money in fixed income, or a third of your money in fixed income, or half of your money in fixed income, or 2/3 of your money in fixed income. That way, you are basically investing in something which will provide greater stability to your portfolio, because even debt funds are volatile, but the volatility is nothing of the equity kind. We see the worst case scenario, which is not unnerving. So I think debt has a reason. Debt should be there in every investor's portfolio. And for short term and medium term, as I said in some earlier question, that less than 3 years, 5 years, you should have a substantial part of your money in fixed income only. So that is why you should have this. So work on this. And equity should be fulfilled by a diversified equity fund, a multi-cap fund, or the flexi-cap, now emerging flexi-cap fund, and fixed income, go with the short-term debt funds.
B.R. Mala has invested in Motilal Oswal Multicap 35 fund, now flexi-cap. The fund has not been doing well, he says, so should he exit?
As one can notice that this is a very strong growth oriented fund, concentrated one as well, about 22 stocks. We keep a very close eye on this fund, as it holds great promise. So I think in good times this fund will, and we witness it even now. All the days on which the market goes up sharply, this fund actually skyrockets. It just goes ballistic. Likewise, I think if we are hopeful that in next 2-3 years the markets will go up and there will be normalcy and companies will be back on their growth track, which I don't witness, which I don't think it's going to happen in a hurry. Then this fund holds great promise. So if you are not a long-term investor, if you don't have time on your side, if you're not going to stick around with 2-3 years, take your money out. And if you have that patience, if you have that time, despite the relatively marginally poor performance in its category, this fund is worth carrying on with.
Manideep Mahankali says it is advised to have an emergency fund for 6 months. So he wants to know what type of mutual funds does he need to create an emergency fund? Is it good to have debt funds in such a scenario?
Yes, absolutely. Debt fund is the only thing which should be part of your, I would say that approach your emergency fund differently in terms of what is your need. If you have young, very young children, if you have old parents living with you, then you need slightly larger emergency fund. The emergencies could require more money. And I think there is a tier of, there are different things in which your money should be invested. One is that, say something like 25, 50 or 40, 50,000 rupees should be on a bank account, and which is accessible from an ATM card anytime. Some cash should be there in your locker. So that is also your emergency, and these are not high yielding. All your fund, all your money should not necessarily be generating returns. So this should be the first layer of your emergency fund. Then comes, where to invest. Assuming that there could be an emergency and you require 5 lakh rupees, that money should be invested in a short-term debt fund. And so do some liberal estimates of your emergency requirement, and that is how you should spread it.
Okay, next question comes in from Manojit Chakrabarti, who does an SIP of 20,000 rupees a month in a liquid fund for his debt portfolio. Judging the current returns of liquid funds, he wants to know if he can invest in banking and PSU fund and corporate bond fund instead with 10,000 rupees SIP each. He doesn't need this money in near future, he says.
Yeah, I don't come across too many investors who are doing their SIP in a debt fund. But if you're very conservative and if you need the money in the next 2-3 years only, it's a good case. Yeah, the risk return profile of a banking and PSU fund is very different from a corporate debt fund. So if you're investing with a 3 years time frame in mind, of course, what you see, and also it is very important to take a note of something very important, which many investors will not be able to believe. What you see, the returns that you see from the different kind of debt fund today, next 2-3 years is going to be very different. It is going to be far less than what you see right now. And if you're chasing recent past performance, you are in for a great disappointment. If you are starting with the expectation that the kind of return which you witness in the return table can be earned again, you are in for a great disappointment. Interest rates have come down. I don't know when they will start going up again, whether they will come down even further from the levels that we are. And that will cause, and we have seen the flight to safety of fixed income investors. So there is absolutely no appetite for any high yield, lower quality bonds in the market. So that has translated into lower returns. So the basic expectation of our 1 year, 3 year return should be moderated substantially. You are in for great disappointment. The risk return profile change difference, which I was saying, that banking and PSU fund, it is perceived to be more safe, and PSU, of course, because it is perceived to be government backed, so it is yielding far lower than corporate bonds. So I would say that I don't think we are in for a calamity. And if you are not in for a calamity, and some good companies, AAA companies or AA companies will survive and thrive, and they will definitely honor the when these funds are investing in those bonds, those companies, we understand that they will honor their promise of returning your capital on time and paying you interest on time, and that is why we see that they have high credit rating. So if with this kind of time frame that you have, if you have more than 3 years, then definitely consider corporate debt fund as well to enhance the return.
NM Rajagopal Sridhar asks why some equity funds like SBI Small Cap and Mirai Asset Emerging Blue Chip are not accepting fresh lump sum and high value SIP investments. Is it that the fund manager doesn't know where to invest?
Yes, the fund manager is finding lack of opportunity for those funds. These funds, and this is called winner's curse in the mutual fund, in the life of a mutual fund. The problem is, these small cap funds or emerging blue chip, which was a very promising mid cap fund. They invest in companies which are, I was referring to winner's curse, a fund as well, and more investors put money. And as more investors put money, it becomes very difficult for the fund to replicate the strategy that it was following, because those are not replicable strategy, repeatable strategy in a predictable way. When you have, implementing a strategy with 100 crore corpus is very different when you have 5,000 crore. And that is what we are witnessing right now. The small cap funds have become too big for this category to absorb. We saw the whole, noise around flexi multi-cap funds. SEBI came up with a circular that all the multi-cap funds have to invest 25% in small cap stocks. And there was absolute, there was such a great nervousness. The whole market got nervous that if the funds are to be forced to invest in small caps. Small caps just lack enough liquidity. So there is not only fund managers, even the market lacks the appetite or the appetite for absorbing that kind of money. So that is why they have put brakes on taking new money. They do it with great regret. Mutual fund companies are in the business of raising more money so that they can earn more fee. But they are unable to find avenues to invest and they find that the scale of investment coming in these funds will actually make those performance not sustainable.
Surendranath Karvanian wants to know how good are non-convertible bonds as mode of investment.
Non-convertible bonds are just ordinary bonds. They will be getting there are three things to a bond. What is the quality of the company which is issuing these bonds? The other is what is the maturity, and the third is how much will it be yielding and how often it will be paying it. So based on these three parameters, you are investing in a bond. I would say that if you have to invest in if you have to invest in a bond, I would say consider a corporate debt fund, because if you have to invest in a fund, the benefit of diversification in a corporate debt fund is substantial, is huge. If you invest 10 lakh rupees in a very good company, high yielding bond, but if it defaults, all your money will be stuck. If you invest in a bond fund and the bond fund manager faces a problem, he will face a problem with 1/20th, 5% of his money. So only 5% of his money will be exposed to that kind of risk. So default and credit risk will be limited, and the benefit of diversification in a fund will be huge. So I would say that non-convertible bonds of high quality companies is not a bad idea. But if you have to invest in a corporate bond, go for a corporate bond fund.
All right, now 25-year-old Virender Jain says he's able to manage his expenses and invest about 30,000 in SIP. He has recently received an inheritance of 25 lakh rupees. And since he doesn't need these funds in the next 5 years, should he be investing this aggressively or conservatively in balanced fund?
This is a sizable money from his point of view. I would say that he should not only be investing conservatively hybrid fund. The time frame is very important. This is so significant that I would like him to spread this money over at least 36 months, 3 years. Because the risk of catching a market high, even with a balanced fund, or the disappointment that happens when you see a big decline if you have invested lump sum. So that is the risk which is worth managing. He should also, his strategy should also depend on what is the likelihood of taking the money. How much time he has. Is he certainly going to need all the money after 5 years, or this money can lie there and be there for many years? Or he will require it for any spending, for buying a house or any alternative land or any such thing. Then I think one has to look at it differently. But to begin with, for next 5 years, invest in an aggressive hybrid fund and have the time period of 3 years and equally divided. And that money should be invested in a conservative bond fund, from where 1/36 part will be invested or moved into the equity or the aggressive hybrid fund every month.
Raj Salyan has allocated a monthly amount to invest in VR recommended multiple stocks. He wants to know if it's advisable to follow SIP method, or is there any other best way to invest for better returns. He has 30,000 month-on-month investment. What should be the SIP amount for each, he asks?
Yes, it is always a good idea to spread your investments over time, and it can enhance your return a little bit. If you look at the kind of returns which our stock recommendations are generating, many stocks have done very well. But I think it requires the discipline. You will have to formulate some principle for yourself. Maybe your 30,000 to be invested in 5 stocks every month, because you certainly should not be investing in 40 stocks. But you should consider the best buys right now, and so that is a smaller universe. Maybe consider investing in 5 stocks every month and do that with discipline. If you try to perfectly time it, you will miss it. So put a deadline for yourself that you will try to time it in next 2-3 weeks, but before the month end you will invest anyway. Because if you don't do that, the investing in stock is a very tricky thing. The moment you have stock, you have a lot of mental bias. When you invest in a stock, and if you buy a stock, say for example, one company stock and you bought it at 500 rupees, it becomes very difficult to buy the same stock 5 days from there at 570 rupees. You think that when it comes back, when it will correct, and you just keep waiting. So you need you need a temperament. You need to formulate your principles and follow that in a very rigorous way. Have the discipline, and I think that will be a great learning as well.
Okay. Next question is by Utpal Datta, who says, when compared with peers, HDFC Hybrid Equity Fund is not performing well. Since its merger, it has given about 4% plus return. Should one exit the fund and invest in some other hybrid fund, or stay invested in this for another year?
We have waited with these funds for a long time, and we are losing our patience. HDFC funds have been, equity as well as some of the hybrid funds, which are some of the biggest funds in their respective category, have been very disappointing. Give it little more time, and after that, I think it has been a test of patience with these funds so far.
All right, today's last query comes in from Shyam Sundar, who wants to know how to decide about the timing at which one has to book profit. He says he's lost many such opportunities. Further, he asks, if he manages to book profit and has no immediate need for that money, where does he invest it again?
This is a big problem. The moment you're in, if you take your money out from the market and you don't need it, I think the primary reason for taking your money out should be one of these two reasons. One is that you need the money for some spending or for some consumption. Take your money out anyway. If you have achieved little less than your desired goal, still take that money out. You won't be disappointed. Your goals are met. The other reason is your investment does poorly. If your investments are good, then I think you should not take your money out ever. The third reason, which comes to my mind is, changing asset allocation. If you have decided to invest 50% of your money in equity, 50% in debt, and your equity money has become 70% because equity has done well, take some money out from equity and invest in fixed income. Take 20%, rebalance it in a manner that your total money at today will become 50-50 again. So you are doing something methodically and in a principled way, because there is no way to solve this problem, because if you take your money out, even if you are in profit, there is a possibility that the market will go up by 20% and you will just be out of the market and remain out of the market forever. I have seen this happening from the period 2003-04 to about 2008. Markets used to double every 6-7 months, and anybody who took his money out could not get opportunity to get in, and they remained out of the market. And that is the period in which we saw one of India's biggest bull run. The market went up from 2,800 points to 20,000 in a span of 4.5 years. So that was one of the lifetime opportunity, and I think and those opportunities will come when you least expect them. I also feel that what has happened in the economic front can drive a very substantial thing. We have seen if you look at the macroeconomics, the cleaning of the banking sector, the reduction in the corporate tax rate. If you look at smaller players getting marginalized and big companies doing well or more resilient, the corporate governance of Indian companies, the sustained inflow into the market. So I think it's just a matter of time. The market, the moment it gets some stability or assurance of stability over a period of time, markets can actually, a good part of the market is still reasonably priced. So those opportunities will come, and if you're out of the market, you will miss it. So be in the market and be out of, move your money out only for these three reasons: asset allocation, your investment has turned bad, or you need the money.
Well, that's it from us for today. Thank you, Dhirendra.
Thank you.
Thank you to all our viewers. Delighted to inform you that the wait for the much-awaited Value Research Premium is finally over. The premium membership will get you a set of special features and services which many of you have been requesting for, over and above the free Value Research Online you've been using. So along with all the questions that are stopping you from investing today, if you have any queries about the premium service, go to VR Helpline on Value Research Online and send them to us. Our team will answer them in the upcoming Q&A session. Bye for now.